Hello folks, Kevin here. It's KDI with your February 20th update. First, my apologies. The phone lit up pretty good this week with the wheat market moving, and I have not had a chance to sit down and kick out a written report yet. I'm not sure if I'll get a chance. It doesn't sound real positive. I got basketball this evening, basketball tomorrow, and Sunday is full as well. So I'm not sure. You may be stuck without a report. This may do it for you for this week. Unfortunately, if something's happening or I need to expand on it, I'll kick something out Monday morning. So today's report, just going to talk about the tariff news and some of the implications of that, and I want to talk about the movement in the wheat market, as that's some of those chart formations we've been watching for a few months are finally showing why, are finally starting to develop as we hoped. So, yeah, first, the tariff thing. It was, as most of you know, the Supreme Court ruled 6-3 that the reciprocal tariffs, that's a key word there, the reciprocal tariffs were unconstitutional and not able to be placed. The question now, a couple questions. Will those tariffs have to be repaid back? Upon this news this morning, the grains all dipped a little bit. Soybeans went negative. They were close to unchanged and were down as much as 16 at one point. Corn didn't move much at all. Wheat was up 8 or 9, and then after that news was up 1 or 2. And then everything was kind of bought back up through the rest of the session. So, not a big market impact today. The dollar was slightly higher before that announced, and it was slightly lower throughout the day after that was announced. So not a lot of movement yet. So on the surface, you would think this would be extremely bearish soybeans, because what we lose is we lose our leverage to force China into the trade deal. To force them, we had just, if you remember, Trump had mentioned we're going to force them to buy another 8 billion metric tons, which gave the soybeans pretty good little boost. And basically, without the tariff, without the reciprocals on there, we could lose our leverage that makes them honest. And with Brazilian beans, $1.50 cheaper, granite quality issues, that presents some pretty major downside risk in the soy complex and the canola complex, the soybean oil complex. So we got to be careful with that. The chatter going in just now, which is, a couple hours after market close, is that they're already devising different tariffs from a different method. I don't know all the legalities, but I'd be surprised if all of a sudden they just raise the white flag and say we're not going to have tariffs on this, so we can't, and that's the end of that story. I don't think that's going to be the case. I think you'll see tariffs come back, and which is probably why we had very limited market reaction to that today. So obviously it's very changeable, and we'll keep track and know more on Monday. So that's all we know today on the tariff side. The wheat side, there's a couple things. I've had some phone calls. I know the what do you call them? The merchandisers are making the rounds, making phone calls, telling everybody to lock their history drives up or do their history drives right now, because these are the highest prices we've seen since last spring. The futures. There's an issue, and it's a very important issue, and I want you've got to judge it yourself. Right, it's your operation. You've got to look at this on how you approach finance and markets. I'll tell you how I approach finance and markets in this. I need about 750 Portland to break even. By the time it gets out here, you take another 70 off of that. So 750 Portland's only about 680 to the farm, and I'm barely covering costs, if at all, at that. So you got to be very careful. And right now, it's just in this situation with white wheat. typically I use a dollar basis for my expectation on a hedge to arrive, a positive dollar. From what I can tell, as of February 20th, we've got a pretty good soil profile. We've got of water. We've got a pretty good stand. I feel like we're on pace for a very good crop, and we'd be right up there back to 2024 levels, if not above. And well, probably not above. We'll see what the spring crop does, but we could at least match it. And if that's the case, my basis implications are not waiting for a dollar. It'd be more like 75 cents, maybe even 60. And so we got to be careful with that. And so if I look at December futures at 6.15, I add 60 cents to that. Now I'm at 6.75. Portland, I minus my fees out, I'm $6 at the farm or less. That's not going to work. That's not going to pay the bills. I'm going to lose money at that. So I don't want to forward contract and lose money. That doesn't make sense to me. There's all the risks in the world going ahead. We've got the entire growing season ahead in the whole northern hemisphere. So the only crop that's getting closer is the Indian crop, and it's got some small issues as well. So it's coming off a potential peak it could have had. So anyway, I'm not going to forward contract at a loss. So I realize these are the highest futures prices we've seen in a while, but it's just, again, it's got to be, if I'm going to forward contract, it's got to be, one, it's got to be above my insurance price. Two, it's got to be above the PLC price, which is below at this time. And so that's where I stand. If you're different and you think you're bearish, that's fine. And the merchandiser says it's time to go, but just understand that you're locking in a loss. And yes, I realize the loss could be larger if it drops. What else was I going to add to that? There was something else. It wasn't insurance. The PLC price, I believe, is $6.25 farm gate. and so we're beneath that. Oh, I know what it was. The other thing is wiggle room. I want to have wiggle room when I do an hedge to arrive, because things can and do go wrong in those. And what can go wrong is if this turns in, let's say we have some ports get blown up, or we have a drought problem somewhere big that matters, and this market or the index funds just keep coming in because grains are too cheap. Whatever the reason, we get into a big bull market. All of a sudden, you've got an inverse market where the front end is higher than the back end, and your $6 hedge to arrive is in an $8 market. And you say, well, I want to roll that ahead. And so you roll that ahead, and it's an inverse. So you lose 50 cents on the roll. Your $6 contract's now $5.50. And now you're really in trouble. Now you're losing $2 a bushel. So I got to have some wiggle room. So if I'm going to jump on a hedge to arrive, I want to start where a price that is profitable with an average basis. And we are not there. We are closer. We are a lot closer than we were a week ago. Thank goodness. But we are not there. So that is my approach. Like I said, if you have a different approach, that's fine. When I make my recommendations and whatnot, it's going to be targets that are based on profitability. And it's hard to say exactly what our break even is. It varies. Our inputs vary, but I think I'm kind of middle of the range of the people that I've talked to. So, and I've talked to a lot of people. So anyway, as for why the wheat market is moving, when it first started up this week, it was pretty down hard on Tuesday, and then we gained ground the next 3 days, double figures. Actually, I think we had a double-digit move every day this week, and 1 down and 3 up. I started looking, it's like, okay, what's driving this thing? Is there another freeze coming? There's really not anything super sensitive that I see on the winter front. The Southern Plains is dry and expected to, probably increase dryness as we go. Longer term maps are not very trustworthy, so who knows? This pattern's been weird all winter, so I would expect weird patterns to continue. So it's probably not weather driven, though some people think it is. The other one is the Ukraine-Russia war talks broke down again, and it looks like Russia's preparing for another major spring offensive. So you've got that, and every year we go through this war, they get less and less sensitive on the grain corridors and the ports, and they're ready to blow them up. So that's part of it. You also got the Iran crude oil thing going on with potential war there. And then probably more importantly, you've got the index funds moving into these markets, and you've got a lot of outside money moving into grains because they're so cheap. I mean, you got grains down at 1985 levels and inputs at 2026 levels, and you've got gold and silver at 2026 levels. You got cattle at 2026 levels, and you've got, oil and grain, or energies and grains are just cheap compared to everything else. So you're getting some buying in that. And what's happened is the combination of that is bleeding into the hedge funds, so they're being forced to cover that big short position. They were over 100,000 short. Now they're, I bet they're 50,000 to go contracts, which is probably another 50 cents worth of a move before they're neutral. Those reports are less and less accurate every time they post them, but that's just based on historical price action. I'm guessing that's where we're about. So might be off by 10,000 one way or the other, but so that's what's going on in wheat. So the charts, we spent a lot of time on that this last fall. We knew the monthly and weekly charts had turned the corner, and we're looking with some looking for some pretty good reversals in the dailies. We had one little rally there, I believe it was October, and then it failed. And this is our second shot at it. So this is probably the best the daily chart has looked in a very long time. So, we'll see if it continues into next week, see if we can actually get up and hit some targets. Longer term, I think the tide, like I say last fall, the tide turned, but it takes a long time to turn the ship around, and it takes pretty good news flow to get that ship to actually move, and we're starting to move. So that's good. But trying to think what else I had. Not a whole lot else to talk about for now. Corn and beans really kind of just a nothing week. I mean, it was kind of a couple things I don't like. One, I don't like seeing corn and beans not follow wheat higher. I wish they were. There may be some spreading there that's unwinding, causing some of that with the hedge funds. So maybe we see corn and beans start to move with wheat next week. The other thing I don't like is Portland's playing games with us in the white wheat market. If I use the export report data that comes out every week, it suggests there's still another 20 to 40 million bushels of white wheat they have to buy on what they've sold. And they, the fact that they did not raise the cash white wheat price 1 cent this week when futures went up over 30, that's pretty telling that they are trying to prove a point, and they can either see our cards and continue to push the narrative that there's so much wheat it'll never go up no matter what the futures are. We know that's untrue historically, but we'll see. Like I say, it's very frustrating to see that. I miss the days when we had 7 exporters. I don't like the days when we have just 4. I think that makes a big difference. I think it makes a huge difference. But all right, that's about all for now. So again, sorry I haven't had time to sit down and crank out something on paper. I'll hopefully get that done Monday or Tuesday, and we'll see what the news flow is. I'm sure it'll be a different world by then. But that's what we got for Friday. Have a good weekend.